We have been talking about uses for management accounting, right, and financial accounting too. Of course, we certainly looked at financial statement analysis, and many of these numbers that we've been using are financial accounting numbers. But the main point of management accounting is to provide the data for managers to make decisions, right? So I'm thinking about the data from that management perspective. So this chapter is really sort of getting into some decision making and using this accounting for management decisions. So let's just get right into this and talk about differential analysis, right? So should I do this or should I do that, right? I've got some choices. They're going to have different streams of revenues and expenses. And so, what should I choose? All right. So the first thing we have to learn is what matters to my decision, right? What data do I need to make a good decision for my organization, right? So a few key concepts help us choose the data we need and apply that data to good decision making. So concept one, you have to figure out your choices, right? So what are my alternatives, right? Am I going to lease this thing, or am I going to buy this thing, or am I going to make this thing? Is this line still profitable enough for me to continue making it? Right, things like that. So you got to figure out what it is exactly you're analyzing first, right? So then you can pick out the data you need, right? So the next concept is, I know what my choices are. What is relevant to that choice, right? What are the relevant costs? And what are my relevant benefits, right? And that's what I pay attention to when I make my choice. Not the irrelevant costs, not the irrelevant benefits. I need to ignore them. Which, especially when it comes to some things like some of your fixed costs, sometimes they're not really relevant to your ultimate decisions. You have to be careful about, because remember, we're just allocating costs sometimes to product lines, and it's appropriate for what we're doing to get to cost of goods sold and such, but it may not be relevant to our ultimate decision. So we'll talk about that more. So the key is we do this differential analysis, right? Here's what I need to focus on, right? Here's my choices, right, that I've figured out. Here's my choices. Here's the data that's relevant. And what's the difference between these choices? When considering only relevant data, what's the difference, right? So what are the costs going to be different between these two choices? Are revenues going to be different between these two choices? Is there something going to increase the incremental cost and avoidable costs? Is there something like, oh, if I make this choice, I won't have that cost? So we have to think about which data we use and leave out the irrelevant stuff. So sunk costs are irrelevant, right? If you're choosing among two paths to go down in the future, right? I'm going to make or buy. I'm going to discontinue this product line, or I'm going to keep making this product line, right? Your choices, they're for the future, right? Well, if you've already got some sunk costs, right? In other words, oh, I've got this machine here that makes this certain thing, right? So I should use it, shouldn't I? No, that's if it's a sunk cost, if it's something you can't get back, can't sell it, it's got no resale value, can't be used for something else, it's a sunk cost, then that doesn't matter to you anymore. You've sunk that cost. And of course, the depreciation that goes with it sunk too, right? So you don't have to, that's irrelevant. Sunk costs are irrelevant. Future costs that don't differ are irrelevant, right? So if my management salary is the same either way, I have to have a manager, I pay him $50,000 a year. It's the same whichever choice I go with. Not relevant to the decision, right? So only future costs, no sunk costs, but if they're the same with all my choices, I don't have to worry about it. You should consider opportunity cost. Opportunity cost is probably a concept you picked up in economics. Is what could I get if I do something else, right? So if I choose this over this, I'm going to lose some other benefit. It can be hard to quantify, I'll admit. So let's just go through a little exercise in identifying relevant costs. Okay, so in this example, we've got a student who's who's in Boston and going to go to New York. Fun. Can either drive or take the train. It's 230 miles in a car, but there's a train that she could take. And so here's the automobile costs, right? And so we're trying to figure out what's relevant, what's not, but here's all the costs. So don't think these are all especially relevant, okay? We're just listing all the costs and then we'll pick out what's relevant in a minute. All right, so we got straight line depreciation, both total and as a per mile, cost of gasoline, cost of insurance and a license, maintenance and repairs per mile, 65. The more we drive, the more it costs. Parking fees and per mile. Total average cost, 61.9 cents per mile. And here's how we calculated that. Straight line, 45 per month, based on a salvage value, right? So just these are our little calculations. So here we go. We've got our costs of the fixed items and we've got our costs per mile. Here's some other stuff. As we drive the car, we lower the resale value. So the more miles, the less it's worth. We need to know how much it's going to cost to ride the train, right? If that's one of my choices, I need all the costs related to it. Apparently, it's going to cost $104 to get the ticket. Here's a benefit, somewhat intangible, because it's got question marks, but yeah, it's easier and nicer to ride a train than to drive, especially from big cities like Boston and New York on the East Coast. I've never driven in New York, but I've driven in Boston, and it's not fun. Cost of putting dog in kennel. Okay, well, they can still have to do that either way. So benefit of having a car in New York, again, intangible. I'm not sure it is a benefit. Hassle of parking, there you go. Per day cost of parking, 20. That sounds pretty cheap. Must not be parking in Manhattan. That's all I got to say. All right, so yeah, some of these seem like they're important costs to consider in addition. All right, so not just the basic car costs. So what costs are relevant? Well, the car cost is sunk, right? She's bought this car. It's not like she's going to sell it or do, it doesn't matter. So like the depreciation that goes with it, right? Doesn't matter. It's a sunk cost. Insurance, not relevant because it's the same. There's no differential cost to insurance and the license and that kind of stuff. Now, gasoline, clearly relevant, right? If you take the train, you avoid the cost of gasoline. So there's a cost, gasoline. Maintenance, the more you run it, the more you have to maintain it. So cost of maintenance, that's relevant. Parking, it's the cost of having your car, but you have to pay it whether you take the train or not, right? So that 61.9 cents per mile, some of those, right? So this number right here, right, is based on things like depreciation, not relevant. Insurance and license, not relevant. Parking fees at school, not relevant. So this is based on some not relevant items. What costs and benefits are relevant? Well, decline in resale. The fare, the round trip fare, clearly that cost could be avoided if she drives the car. She doesn't have to pay the $140 for the ticket. Relaxing on the train is relevant, although, like we said, there were question marks there. Hard to assign a dollar value. Kennel cost not relevant. The dog has to go to the kennel whether she takes the car or the train. Parking in New York, definitely relevant. If she takes the train, she doesn't have to park. Parking in New York and having a car to drive around in are relevant, but it's kind of hard to assign a dollar amount. I don't know. Honestly, I think if you're going to go somewhere where you would have taken the car, they should have like cost of an Uber or cost of the subway. You know, if you're going to have to get around while you're in New York, then this probably should be a relevant cost, but I don't think they go quite that complex. All right. So if you look at the relevant stuff, right, the cost of driving, well, we're going to have to pay for the gasoline, $46. It'll increase our maintenance cost, $29.90. Our car won't be worth as much because it'll have high miles, $11.96. Parking in New York will cost $50. And also, I do think if you're taking it to New York because you want to have something to drive around while you're there and you were going to drive out somewhere and go see something, go to the beach or something, well, now you're going to have to take an Uber or take the subway, so that costs some money. So I do think you should include that, but that's just something they didn't think about. Anyway, then the cost of taking the train is $104, right? But again, I would add in like an Uber or something. So if you have the car, you don't have to pay for an Uber or a subway ticket, but if you take the train, you will. Maybe your friend has a car and they're going to drive or something. Maybe that's why it's not in there. All right. So anyway, there you go. So if you're making it solely on cost, $104, go take the train. But again, there may be some other reason that you want to have the car there. You were going to also stop somewhere on the way back and do something else. You know, again, a difference of $33 is not a whole lot. To a college student, it might be, but you know, that probably wouldn't be my sole decision. I would definitely take the train. All right. So let's look at another problem. All right. So here we are considering a machine that rents for $3,000 a year. All right. So here's the data about the sales with and without the new machine. Okay, so they've got it all lined up here. Here's my current situation. I'm going to sell 5,000 units at 40 per unit. This machine isn't going to help me sell any additional units, right? It's just labor saving, right? So the sales still the same. So there's nothing differential there. Variable expenses. Well, I still have materials. They're the same. So no differential there. But my direct labor will decrease from 40 to 25. And so there we have this differential benefit of $15,000. All right, so overhead doesn't change. Contribution margin again is better by 15,000. All right, and anything else. But now I have to rent the new machine, right? So nothing else changes except for the machine rent. So take that out. So 15,000 minus 3,000 gives me an additional $12,000 of net operating income. Right, so that looks like it's probably okay, right? All right. So the only costs that differ are the direct labor and the fixed rental cost. So that's pretty easy, right? So instead of listing all of this stuff, right, And looking at that and getting all these different numbers and getting them together and looking, I can just look at the differential costs, right? The things that are different, which is decrease in direct labor, increase in rental, financial advantage, 12,000, right? So I didn't really need to do all of that. Now, differential approach is good because sometimes you don't have all the information you might want. You just have the differences. And if you set up a sheet like this with all this other extra data you don't need, it's going to fog decisions. People will start looking at things and get confused. So it's a good thing to just look at the differential. Okay, so there you go. So just picking out the differences and looking at them. That's a technique you want to remember. Be sure you know how to recognize what's relevant. That is important. That's why that's important. So next objective, let's figure out if a product line or other business segment should be dropped or added, right? So we're going to use our analysis techniques to figure out, hey, is this thing still useful to us? Will it still increase our profits, right? If something's going to continue making me profit, I want to do it. If it's not, I don't. If it's going to make me more profit, I want to add it. If it's not, I don't. All right, so whether we're going to drop an old segment or add a new one is primarily based on financial impact, right? So we got to look at our costs, right? So here's a little example. People don't buy watches anymore. So this company is thinking, well, maybe we'll quit selling digital watches, right? So what are we going to do about this? They buy, smart watches. Well, obviously, dropping the digital watch, we want to think about if it will increase our profits, right? However, they are selling, so they do contribute, and we have we have to think about our fixed expenses that would still be around, that we no longer have this segment to contribute to, right? So let's take a look at this segment. So we're going to look at just the segment income of these watches. Okay, so if we look at just the watches, we sell $500,000 worth of watches. Here's the variable expenses, right? So for every watch I make, here's my costs, just the variable. So when I'm done, these watch sales are contributing $300,000 to cover fixed expenses, right? So that's interesting, right? So if I discontinue selling these watches, I'm not going to get the contribution margin, the $300,000 that they're contributing to the fixed stuff. So which of this fixed stuff now is relevant to my decision? That's kind of what we have to think about. Because if you just look at this, right, if you just look at the segment and its net operating loss, right, they have an NOL $100,000. So if all you look at is the segment and its income statement, you're going, oh, get rid of these watches. They're losing us money. But let's remember, some of your fixed expenses are for capacity, and you can't get rid of them just because you get rid of these watches, right? It's kind of depends on how your factory's set up and what's going on, right? Because some of this stuff might be, well, probably not the manager of that particular line, but some of this stuff is about capacity for the factory as a whole, and it's only just been allocated to these watches. So if you don't manufacture these watches, it's going to get allocated to something else, right? So we need to kind of take that stuff out of the mix, right? So let's look at what these cost. So we know that when we sell 500,000 worth of watches, we're ending up with 300,000 contribution margin. So we got 300,000 bucks to cover fixed expenses. Now, it's currently not covering the fixed expenses assigned to this segment, right? The fixed expenses assigned to the segment total 400,000, which gives us an NOL of 100,000. But let's look here. An investigation revealed that the fixed general factory overhead, so this 60,000, and the fixed general administrative expenses will not be effective. So right there, they'll just get reallocated to other products lines. So they aren't really relevant to this decision, right? Because it's the same either way. I still have this expense and this expense, whether I have these watches or not. Now, the equipment used to manufacture the watches has no resale value or alternative use, right? So there's a sunk cost. It's gone. It doesn't matter anymore, and neither does its depreciation, right? So now we've gotten rid of, out of our decision, we're going to get rid of this factory overhead, which is going to stay whether we have watches or not. General and administrative is going to stay whether they have watches or not. And depreciation for equipment we can't sell or do anything with doesn't matter. Okay, so what does that mean? Well, let's take a look. So if we look just differentially, now we're taking the contribution margin, right? Because the rest of it doesn't matter. The variable doesn't matter for this decision because we're talking about after the contribution margin. So starting with my 300,000, and if we drop the watches, we would drop the salary of the line manager, the advertising for those watches, and the rent for that part of the factory, right? So if you add these up, now the fixed expenses attributed to the watches would be 260,000. So 300,000 minus 260 is 40,000. So if I drop this watch line, I'm losing $40,000 that's helping cover the factory's overall expenses for other stuff other than watches. So, right, this is stuff that has just simply been allocated to the watches, right? We're still going to have to pay it, but the watches are helping cover that. So we should keep the watches. They're contributing. Now we could just prepare comparative income statements with and without the watches. So there's another approach, right? So we do this, right? Here's what's going on now with the watches. Our net operating is keeping it. So here we go. So if we drop the digital watches, we'll have none of the sales and none of the variable and none of the contribution margin. So this stuff, these numbers here, are all going away. We no longer have our 300,000 contribution margin, right? So then now we're looking at fixed expenses, like what of that is going to stay? Well, the general factory overhead would be the same. So even if we drop digital watches, right, and all this is gone, we still have the fixed. We no longer have this. We no longer have this. No longer have that. No longer have that. Oh, right. But we do still have. this, right? So there you go. So this goes away. Depreciation. Are irrelevant to the decision. There we go. And of course, if you drop the digital watches, that's going over to the factory. So our total fixed expenses are 140, and the expenses that will go away are 90, 170. And so there we go. And we still end up with our 40,000, right? So in other words, if we drop the digital watches, we become less profitable. We have a bigger net operating loss, bigger loss right here. And the difference is 40,000. So we've set up the two financial statements and we come up with the same decision. Keep making the watches. So what does that tell us? Well, it tells us beware of allocated fixed costs, right? Why would we keep that digital watch sections when it's losing 100,000? Well, it's because what we've done is in this factory, we allocate common fixed costs, right? So if it's a common fixed cost, now instead of going to watches, it's going to go to, I don't know, whatever else they make there, phones, something like whatever else they make in there. Now those fixed costs are going to go over onto them. So as long as that contribution margin is helping covering some of the common fixed costs, yeah, right after you get rid of the variable costs because they all go with the product line. And then you get rid of any fixed costs that are only for the product line. If you still have some contribution to those shared fixed costs, the common costs, then you keep the line. All right, so we'll stop there and we'll come back with a new topic on how to make some decisions on whether we make or buy.